Let's begin our conversation with Workday as we get into some of the big movers this morning. Renita Young joins us from the newsroom for a look at the numbers. All right, big sell-off here, Renita. Not a great start for these cloud companies.
Right. It's because the company trimmed its full-year guidance for a key metric, that's subscription revenue, and the current quarter guidance that the company gave came in lower than expected. So for subscription revenue for the second quarter, it's expecting $1.89 billion. That was lower than what analysts had projected at $1.9 billion. For the full year, the company is expecting subscription revenue of up to $7.72 billion. That's the high end, but that high end is down from the prior high end, which is $7.775 billion. Now, the CEO says this updated guidance is really reflecting that higher sales scrutiny and lower customer headcount growth. But when we look at earnings, they still beat expectations. Adjusted earnings came in at $1.74 a share, and revenue grew around 18% to $1.99 billion, beating estimates. Subscription revenue grew almost 19% year over year. And by the end of the quarter, the 12-month subscription revenue backlog was at $6.6 billion. But none of that stopped analysts from cutting price targets today. Many of them, KeyBank, Barclays, JP Morgan, Citibank, Goldman Sachs, they're among cuts. The lowest of these came from Citibank at $255, coming down from $293, but kept it at a neutral rating. Those others that I mentioned kept it at either an overweight or buy rating. Want to highlight a couple of comments, though. Barclays said that the main focus now will be around the RPO miss that the company had and subscription revenue guide down. A lot of people, by the way, a lot of analysts talked about that subscription revenue guide down, as well as the higher sales scrutiny being their reason for cutting the price target. Now, KeyBank did cut their price target to $275 from $330, keeping it at an overweight rating. They say despite the macro challenges and the slower than expected customer headcount, of course, they still have a long-term positive view of the opportunities for this company. So there's a little bit of positivity injected in this truly mixed report.
Okay. All right. So the bulls are not breaking, it doesn't sound like, but guidance definitely going to make some revised expectations, I think, when there's now been a couple of quarters where they haven't pumped up the numbers the way the street was looking for. All right, stock getting hit, the whole group now red. This combined with Intuit, just kind of the ugly start for cloud companies. All right, thanks for the heads up.